Imagine you have $10,000 to invest. Do you put it into the stock market, where your money can grow passively over time? Or do you use it as a down payment on a rental property that generates monthly income? Which option would you choose? More importantly, which one is the smarter investment? This is one of the biggest debates in the world of investing. On one side, you have stocks, fast, liquid, and historically strong in returns. On the other hand, real estate is tangible, stable, and a great way to build long-term wealth. But which one truly builds more wealth? Which investment suits your financial goals? Think about two investors. Mike, the stock investor, started investing in the S&P 500 5 years ago. His portfolio has grown steadily, compounding over time. He doesn't have to worry about tenants, maintenance, or property taxes. He just checks his portfolio and lets his money work for him. Sarah, the real estate investor, took a different approach. She bought a small rental property, and while she had to deal with repairs and tenant issues, she now earns passive income every month. Plus, her property's value has increased, giving her extra equity. Now here's the big question. Who made the better choice? Mike or Sarah? By the end of this video, you'll have a clear answer. We'll compare stocks and real estate in terms of risk, returns, liquidity, effort, and overall wealth building potential, so you can decide which investment fits your financial journey. Let's dive in. Number 1. Initial investment and accessibility. Let's say you're ready to invest, but there's a catch. You don't have a lot of money to start with. So, what's the better option? Buying stocks or purchasing real estate? Think about it. Can you really own a piece of Amazon, Tesla, or Apple for just $100? Absolutely. But can you buy a house with that same amount? Probably not. When it comes to getting started, stocks are the clear winner. You can open a brokerage account today, deposit as little as $10, and start investing in fractional shares of top companies. No paperwork, no banks, and no massive upfront costs. Now compare that to real estate. Even if you're looking at a small rental property, you'll likely need a down payment, typically 10 to 20% of the property price, as well as closing costs like fees, inspections, legal paperwork, and ongoing maintenance. Let's put this into perspective. If you want to buy a $200,000 rental property, you might need at least $20,000 to $40,000 up front before even seeing a dollar in profit. On the other hand, with that same $20,000, you could invest in a diversified stock portfolio and start growing your wealth immediately, without worrying about tenants, property management, or repairs. Number 2. Risk and volatility. Imagine waking up one morning, checking your stock portfolio, and seeing that it's dropped 10% overnight, just because of a bad earnings report or a market crash. How would you feel? Now picture this. You own a rental property, and your tenant suddenly stops paying rent. Months go by, and you're stuck covering the mortgage, property taxes, and repairs. Both scenarios sound stressful, right? But which investment is actually riskier? Stocks or real estate? The stock market is highly volatile. Prices can fluctuate wildly within minutes based on news, earnings reports, or economic events. In 2020, for example, the S&P 500 lost over 30% of its value in just a few weeks when the pandemic hit. But guess what? It recovered and reached new all-time highs. Property values don't crash overnight, but they do have risks. Think about the 2008 housing market crash. Home prices dropped by nearly 30% in some areas, and many people lost their homes. Unlike stocks, though, real estate values tend to decline slowly rather than suddenly. So, which would you rather deal with? A stock portfolio that can drop instantly but bounce back over time, or a property that might take years to recover if the market crashes? Beyond volatility, let's talk about other risks. Stocks are more exposed to emotional investing. People panic sell when prices drop, locking in losses instead of waiting for a rebound. Have you ever sold a stock out of fear, only to watch it go back up later? Real estate comes with hidden costs. A tenant stops paying rent, unexpected repairs pop up, or property taxes increase. All of these can eat into your profits. Number 3. Liquidity. Let's say you suddenly need cash. Fast. Maybe you have a medical emergency, an unexpected expense, or a once-in-a-lifetime investment opportunity. How quickly could you sell your stocks? And how quickly could you sell a house? The difference could mean being financially secure and stuck with a property you can't offload. Liquidity refers to how quickly and easily you can convert an investment into cash without losing much value. Stocks are super liquid. You can log into your brokerage account, hit sell, and your money is available within minutes. Within a few days, it's in your bank account. No waiting, no middlemen, no paperwork. Real estate is the opposite of liquid. Selling a house can take weeks or even months. You need to list the property, find a buyer, negotiate, deal with inspections, and close the sale. Plus, you'll pay agent fees and closing costs. If you own $50,000 in stocks and need cash, you can sell some shares today and have money within 2 to 3 days. But if your $200,000 rental property is your investment, you're in for a waiting game. Even in a good market, it could take months to sell. In a bad market, you might have to drop the price significantly just to find a buyer. So, here's the big question. Would you rather have an investment that you can cash out in minutes? Or are you okay with waiting months to sell real estate? Share your thoughts in the comments section. Number 4. Passive versus active investment. You're lying on a beach, sipping your favorite drink, while your money is working for you. Sounds great, right? But does investing in stocks or real estate actually allow you to do that? The answer depends on whether you prefer a passive or active investment. Stocks are one of the most passive ways to invest. You buy shares in a company or an index fund, sit back, and let compound growth do its thing. No phone calls, no maintenance, no managing tenants. If you invested in an S&P 500 index fund 10 years ago and never touched it, your investment would have nearly tripled without lifting a finger. But here's the catch. You need patience. The market has ups and downs, and emotional investors might panic sell at the wrong time. Real estate, on the other hand, requires work, a lot of it. You have to find the right property, negotiate, finance, and close the deal. Then comes managing tenants, handling repairs, and paying property taxes. Let's say you own a rental property. One day, your tenant calls in the middle of the night. The water heater broke. Now, you must either fix it yourself or pay someone to do it. Either way, it's your responsibility. So, here's a question. Would you rather invest passively, letting your money grow on autopilot, or actively manage a real estate business for higher returns? Number 5. Potential returns and growth. Let's get real. You're investing because you want to grow your money, right? But the big question is, will you make more money investing in stocks or real estate? Imagine two people. Sarah invests in stocks. She puts $10,000 into an S&P 500 index fund and forgets about it for 30 years. Mike buys real estate. He puts $10,000 as a down payment on a rental property, collects rent, and sells it years later. At the end of 30 years, who makes more money? The answer might surprise you. Historically, the stock market has averaged 7 to 10% annual returns after inflation. That means if Sarah's investment grows at 8% per year, her $10,000 turns into over $100,000 without her doing anything. And if she keeps adding money, it grows even faster. If she invests just $500 per month, she could have over $1 million in 30 years without ever managing a property. Now, Mike's real estate investment works differently. He leverages his $10,000 by getting a mortgage to buy a $100,000 property. Over time, the property appreciates in value around 3 to 5% per year. He collects rental income, which increases over time and benefits from tax advantages like depreciation and deductions. If his property value doubles in 30 years, it's worth $200,000. And he also earned rental income along the way. But here's the catch. He had to actively manage the property, deal with repairs, and handle tenants. So, the growth is steady with almost no effort when you invest in stocks, whereas investing in real estate can give you high returns, but with more work. So, which investment would you choose? Number 6. Tax advantages. Nobody likes paying taxes, but here's the secret. The right investment can help you legally pay less in taxes. Would you rather lose a chunk of your profits to taxes every year or keep more money in your pocket? Stocks and real estate both offer tax benefits, but one of them gives investors way more ways to reduce their tax bill. Let's break it down. Investing in stocks is simple when it comes to taxes, but there aren't many ways to lower what you owe. If you hold a stock for over a year before selling, you pay a lower tax rate than regular income. Some stocks pay dividends, and depending on the type, they might be taxed at a lower rate. If you invest in stocks through a 401k or Roth IRA, you can either defer taxes or avoid them altogether. For example, if you buy Tesla stock at $200 and sell it years later at $500, you only pay tax on the $300 profit. But avoiding that tax is impossible unless you invest through a retirement account. Real estate investors win big when it comes to tax advantages. Here's why. You can write off the depreciation of your property. Even if its value goes up, you can deduct the interest you pay on your loan from your taxable income, and even your property taxes can be written off. A legal loophole lets you sell a property and reinvest in another without paying capital gains tax via the 1031 exchange. Also, rental income isn't subject to self-employment tax like other businesses. Number 7. Leverage and debt. What if I told you that you could buy a $300,000 investment with just $30,000? Sounds crazy, right? But that's exactly what leverage allows you to do. And it's one of the biggest differences between real estate and stocks. Leverage lets you control a large asset with a small amount of money, but it also comes with risk. So you need to know how to use it wisely. Is leverage your best friend or your worst enemy? Let's break it down. In the stock market, leverage exists, but it's a double-edged sword. Margin trading. Some investors borrow money from a brokerage to buy more stocks. If the stock goes up, you make bigger profits. But if it goes down, you lose more than you invested. Options trading. Some traders use options to control large amounts of stock with a small investment. But if the market moves against them, they can lose everything fast. No fixed collateral. Unlike real estate, no tangible asset backs the debt. If the market crashes, margin traders can be forced to sell at a loss. Let's say you have $5,000 and borrow another $5,000 on margin to invest in Tesla stock. If Tesla's price goes up 10%, you make double the profit. But if it drops 10%, you lose double, and your broker might force you to sell at a loss to repay the loan. That's why margin trading is not for beginners. Real estate is one of the few investments where using debt is considered a smart strategy. Why? Because you're using the bank's money to buy an appreciating asset. Mortgages. You can buy a property with as little as 5 to 20% down, but you still control 100% of the asset. Rental income covers debt. Your tenants pay your mortgage through rent, helping you build equity without using your own money. Fixed interest rates. Unlike stocks, where margin rates fluctuate, real estate loans have fixed rates, making debt more predictable. Tax advantages. Mortgage interest is deductible, reducing your taxable income. Let's say you buy a $300,000 rental property with a 20% down payment. If the property appreciates 5% per year, in 10 years, it's worth $488,000, but you only invested $60,000 up front. That's the power of leverage. Number 8. Market factors and economic trends. What if you invested all your money in something only for the market to crash the next day? Stocks rise and fall. Real estate values shift. Inflation eats away at your wealth. But here's the real question. Which investment better survives economic ups and downs? Stocks or real estate? The answer might surprise you. Stock prices react fast to economic news, interest rate changes, and even global events. In good times, stocks can grow fast, but in recessions, they can lose 50% or more of their value. When rates go up, borrowing gets expensive, and companies struggle, driving stock prices down. Stocks can act as a hedge against inflation, but not always. High inflation can hurt companies by increasing costs and lowering profits. Wars, pandemics, and financial crises can cause sudden stock market crashes. The S&P 500 lost nearly 50% of its value during the 2008 financial crisis. But if you held on, the market eventually rebounded and hit record highs. The key: patience and long-term thinking. Real estate doesn't crash overnight like stocks, but still follows economic trends. Prices tend to rise over time, but downturns can last for years. During economic slowdowns, people struggle to buy homes, and prices can dip, but not as dramatically as stocks. Unlike stocks, real estate benefits from inflation, as property values and rental prices tend to rise over time. When rates go up, mortgages become more expensive, slowing down demand and price growth. In 2008, real estate crashed hard, with home values plummeting 30 to 50% in some areas. But unlike stocks, many investors held onto their properties, collected rent, and waited for values to recover, which they eventually did. Number 9. Diversification and portfolio strategy. Imagine putting all your money into one investment, and then it crashes overnight. How would you feel? The stock market tanks. Real estate prices drop. Your savings shrink due to inflation. That's the risk of not diversifying. You're at the mercy of one market if you rely on just one investment. But smart investors know how to spread their money to protect and grow their wealth. So, how do stocks and real estate fit into a balanced portfolio strategy? Let's dive in. Stocks offer built-in diversification. If you invest the right way, instead of buying just one stock, you can invest in hundreds through index funds like the S&P 500, reducing risk. Investing in different industries like tech, healthcare, and energy protects you if one sector crashes. You can invest globally, reducing dependence on any single country's economy. If you had only invested in tech stocks in 2022, you would have lost 30 to 50% of your money. But if you held a diversified portfolio, your losses would have been smaller, and you'd recover faster. Real estate adds stability to a portfolio because it's not directly tied to the stock market. Even if property values dip, rental income keeps coming in. Owning real estate in different cities or states helps balance local market downturns. If you don't want to own physical property, you can invest in REITs, companies that own and manage properties, just like stocks. During stock market crashes, many investors move money into real estate because it holds value better. That's why having both stocks and real estate can be a smart strategy. The best portfolio is a mix of both. A balanced investment strategy combines stocks and real estate. Stocks provide high growth potential and liquidity, while real estate offers stability and passive income. Who should invest in what? Not all investments are one size fits all. What if you could double your money in just a few years? Sounds amazing, right? But what if that same investment could also wipe out half your savings overnight? Choosing between stocks and real estate isn't just about returns. It's about what fits your financial situation, goals, and risk tolerance. So, let's break it down. Stocks are best for investors who want low upfront investment, liquidity, high growth potential, and passive investing. If you're a young professional earning a steady salary, stocks might be a great option because you can invest small amounts regularly and let compounding do the work. Real estate is best for investors who want tangible assets, stable cash flow, tax benefits, and leverage. Real estate can be a fantastic way to generate passive income and build long-term wealth if you're a business owner or have extra savings. At the end of the day, the best investment is the one that works for you. Whether it's stocks, real estate, or both. Start now, stay consistent, and watch your wealth grow. If you found this video helpful, hit that like button, subscribe for more investing tips, and turn on notifications so you never miss a new video. Until next time, keep investing and building your future.